Hello and welcome to a brand new show of Market Makers. 2016 so far is off to a very poor and a disturbing start. We've seen a further gut-wrenching fall in commodities. China continues to be the pain point of the world, and now the biggest market in the world, which is the US market, that also has started correcting. So what has led to chaos, wealth destruction and confusion in global financial markets? Frankly, if I have to recall a timeline, it is more like a replay of August and September 2015. But is this a good time to put money to work, or this is just the beginning of pain? Global experts are drawing a parallel that this could be a repeat of 2008. Is it as bad as what some global experts are pointing, or is it time to think contra and think smart? To discuss what is the way forward, I have with me a very smart investor, someone who truly believes in the ethos of value investing. Ravi Dharamshi. Ravi, fantastic to have you back. Thank you for joining us. Happy New Year. Well, I said it only once on 1st of Jan. Haven't used that phrase after that.
Thanks Nikunj for having me on the show, and still Happy New Year. Markets can take a rest. It will be a good year. Don't worry.
Why do you say that?
See, first of all, 2015 was a challenging year. The genesis of what we are witnessing in 2016 lies in 2015. For example, in domestic factors, we did not get a good monsoon. There were legislative reforms which got blocked. Then the earnings cycle didn't pick up. Economic revival got delayed. Then coming to international factors, there was a China slowdown, there was a crude and a commodity crash, and a US Fed rate hike. Given all this, an correction is par for the course. So nothing has happened in the market which is absolutely unexpected. And to begin with, I don't think there was so much irrationality that we will overshoot on the downside. So my strong belief is that we will witness the markets bottoming out sometime this year, early this year, and a nice rally followed by that.
Okay. So the point which I want to discuss or debate with you is that China's slowdown is yesterday's data. That is not tomorrow's story. Yet markets are reacting to historical facts. Why is that?
See, who is hurting where, we don't know. Nobody expected $30 crude to be here. Today it's a reality. So no doubt the trends have gotten accentuated, whether it is commodities or whether it is currencies. So that is reflecting somewhere. And the second and third order derivative of that is the equities and Indian equities, which is also feeling the pain somewhere. There is a global receding of liquidity, whether it is the US Fed rate hike or whether it's the sovereign wealth funds who are hurting or the countries, oil producing nations that are hurting. Overall trade activity is down. So there is a general receding tide of liquidity, which is leading to all kinds of asset becoming cheaper, but commodities especially, because there's a direct correlation with the China, and equities to a lesser extent.
Global experts, and especially George Soros, or let me put it this way, Mr. Soros believes that there are echoes of 2008. He believes that 2008 may repeat itself. Ruchir Sharma is of the view that the world has seen recession in every 8 years, and 7 years have passed after 2008, so a recession is coming.
So it all sounds very poetic that every 8 years we'll have a recession or a market correction, and nobody knows. What we are talking about is future. So it can rhyme, but it doesn't necessarily have to exactly match. So we are having some sort or some version of a correction, definitely. But is it going to be like 2008? 2008, there was a huge speculation. There was over leverage. There was huge fundraising from the corporates. Everybody had let their guard down. That is not how 2015 was. Was there some amount of overvaluation? Probably. Was there some amount of speculative activity? Yes. But nothing that can compare with 2008. And if that is not the starting point, we cannot be blindsided and we cannot have the kind of fall that we had in 2008. So from Indian stock market point of view, I don't think it is the same as 2008.
Do you think the extreme sell-off in commodities will have a huge impact on financial adjustment which we are anticipating? When markets or when commodities they fell in 2014 and 15, we celebrated the first fall. Now we are worried about the fall.
So the adjustment process is on, And my judgment is it's probably towards the end of it. I mean, I don't think it is now that we should be start worrying about crude going to $20. Of course, $30 to $20 is also a huge fall, but the incremental pain is not as much as 100 to 30. So it's not something that I would be worried about from a flows point of view. I think it is getting reflected, and I am actually looking for market. I mean, market is entering a value zone, and I would be waiting to buy if that happens.
Why do you think markets are entering a value zone, and between large cap and mid cap, where is the real value in this market?
On a broad level, for sure, large caps is where the value is, because FIIs were the first one to start selling since February, March of last year, and till date they continue to be the sellers, while domestics have constantly been getting inflows, which has led to mid caps and small caps being a little overvalued. So in terms of relative value, large caps is the place to be, and I think overall the value zone, I mean, I can't predict to the T, but I think within 10% of the 10 to 20% of stock price and within 10% of indices, I think we should be in a very, very good value zone.
So 10% and you would be a perma bull.
I think so. I am bullish even today. I don't know if markets are going to bottom out today or 3 months down the line or 6 months down the line, or here or 5% lower or 10% lower. I can't predict that, but I think it's not the time to start worrying about things that you should have been worried about a year back.
Ultimately, what drives any market are two factors: liquidity and earnings. Liquidity, very hard to fathom in the short term. Let's talk about earnings, something which we can calculate and something which we can project. What's your take on where earnings will move for India?
So last year we did not have the economic revival that we were all eagerly anticipating, but there is a brighter chance that we will have some sort of a revival this year. It might not be a broad-based revival. It will not be, that economy is clocking 9% or something, but there will be more greener shoots than red shoots this year. One, statistically, I don't think we can have a bad monsoon this year, but touch wood, it's a statistic. We have never had 3 bad monsoon in a row. Second, I think the input costs are going down, the fuel costs are going down, power costs are going down, logistics costs are going down. What is not reviving is the demand growth. Capital is again still a scarce resource, so it is being judiciously used. So markets tend to follow the return on equity, and if the return on equity should pick up with a slight pickup in growth, and we can witness this at a sectoral level. Like, say, for example,
oil consumption is moving up, road construction is moving up.
Yeah, I mean, passenger traffic is up, car sales are up. So you have to pick and choose where those green shoots are showing sooner than the other sectors. But once that small amount of growth picks up, the effect on the bottom line will be bigger. So I am very sure that this is the year when the earnings cycle overall will bottom out. How big the throwback is, we need to see. It doesn't look like it's going to be a broad bullish earnings cycle revival, but there will be you will find opportunities where you can invest.
So I'm going to cut from global picture to sectors. The pain or the intense pain is there in the banking space. If markets are of the view that economic revival is going to dawn on us very soon, financial should actually be in a sweet spot.
No, markets are not of the view that there is an economic revival on the horizon. In fact, whatever expectation we had of revival is now getting washed away. Okay. The expectations are moving to the other extreme, that we are not going to have an economic revival, and that is what being reflected in the...
So the selling in banks, is that justified?
If it is a 6-month, 12-month view, probably it is justified. But if you are looking for a 3-5 year kind of an opportunity, this is the time that you should have your ears alert, and you should be looking for an opportunity. Over the next 2-3 quarters is where you will find an opportunity in the financials. It's not like the economic revival is not going to happen, and it's not like the NPA cycle is not going to peak. It will happen, and the valuations will hit a rock bottom sometime.
But they are not at a rock bottom according to you.
See, the problem that we are grappling with is that we are unable to estimate the extent of the problem. Sometime, because of the RBI directive and tightening belt, this in the next 2-3 quarters, I believe that we will get a hang of that. We will be able to pinpoint and say, no, this is what the book size is, of this particular bank. And when that happens, then you have some amount of confidence that this bank is not going to go down under. And that is when you will be, you'll find the stock prices bottoming
buy
out.
banks only after 31st of March 2016?
I don't know exact date. Prices could bottom out sooner than the actual write-offs come through. But I think this particular quarter, the result season that's going on, we'll have a lot of washout quarters in banking. And maybe this is the quarter where they bottom out, or it could be one more quarter.
We've always debated PSU or private. Let me change the definition. Wholesale versus retail. Wholesale means you're bullish on India, you're bullish on corporates. Retail means you're bullish on urban, you're bullish on the retail participation. Which way are you leaning?
No, definitely retail, because I believe the revival in the economy is going to be led by the consumer and not so much by capex. Government capex is happening, but that is not enough to revive the entire economy immediately. So the pain point in whether it is the stalled projects. See, the corporates need to see money flowing for a couple of years before they can commit fresh capex. So, in my opinion, the economic revival is not going to be led by capex and definitely not by private capex. So, one needs to be focused on the retail or the consumer side of the economy.
Okay, the sector which you've liked, we've discussed again on this forum in some of our previous shows, is pharmaceutical. And disturbing news is coming for the pharma sector per se. First, I thought it was a problem with Sun Pharma or Cadila. Now it's a sector-wide problem. On a daily basis, more and more FDA problems are surfacing up. Pricing also seems to be coming down. Is the best behind us?
See, in the last 5 years, pharma sector has churned out dramatic multi-baggers. So I wouldn't be surprised if this year turns out to be a year of consolidation for the sector as a whole. Having said that, it's still a stock picking sector, and you need to, in the same pharma sector, we have had a Sun Pharma over the last 5 years and Ranbaxy, which has not done anything. So you need to be correct about your stock picking. You need to understand which stage of the inspection cycle is that particular company in, what is the pipeline looking like. So over a 3, 4, 5 year horizon, a stock that has corrected 30, 40, 50% or has already had an FDA issue is probably a good stock to look at.
So Sun Pharma should be on somebody's radar.
It should be on the radar. It should be on the radar. I have no clue when the halal issues get revived, but it should be on the radar.
Your exposure to pharmaceutical, Natco or Windows, something which we've discussed in the past. Have you exited your exposure?
No, I continue to believe that that those particular companies have a brighter future, and we might have tinkered with the weightages here and there, but we continue to.
But you are a believer in the Indian pharma stocks?
Yes. I have no clue that the generic story is here to stay, and how the companies will have to upgrade themselves to finding niche opportunities, complex opportunities, biosimilars, maybe innovative drugs. So those are the learnings and the upgradation.
Focus on complex generics largely.
So each particular company will find its way to address that. But this opportunity is huge, and the company still, India still remains small in the context of the world. Like Teva, if it is the largest generic, is about $60 billion market cap. And Sun Pharma is now at about $25-26 billion kind of a market cap. So you cannot be looking at Sun Pharma being 1,75,000 crore market cap in context of the Indian equities. You have to compare it with the Tevas and the Mylands and the Actavis of the world.
What we've seen off late in the last 6 months, and that's the good news, new companies, great businesses, niche businesses, they're going public. It started with Indigo, then you had Dr. Path Lab, Dr. Lal Path Lab, then SM Kelkar, adding to that was Narayana Healthcare. What's going on in the IPO market?
So 2015, that is definitely a bright
That's a high
spot.
point, yeah.
It's a bright spot that IPO markets have revived. And they have not revived because there has been a gush of money or a lot of fundraising. It's revived because there is quality paper coming, and that quality paper has made money for the investors. So that is really the ball has started rolling. The retail investors have started experiencing returns. So they'll come back, and that is what is going to make the market move up, because I think the financial savings story that has started in 2015, money moving from physical savings to financial savings will play out and it has a long runway. It's not going to get over in a year.
The latest entrant on a thematic basis in your portfolio is actually aviation. Now, Buffett for the longest time has argued that aviation, it's a gruesome business. Why are you bullish on aviation? Are you bearish on crude? Is that the reason why you're bullish on aviation?
So I won't say that I'm very bullish on aviation as a sector, but there can be exceptions.
You like the market leader there?
Yes, the market leader. So there have been globally, there's a Southwest airline, there's a Ryanair, JetBlue, EasyJet, who has created wealth. They've been fantastic performers. They've been like 40, 50 baggers over the last 5-7 years. And that tells you something. I mean, why? So they are really, really cost leaders. Second, they are focused on their market. Third, they are focused on their activity, what they are doing. They serve a particular segment and they understand what their offering is and they stick to that. So the market leader over here, I believe, stands in that category, who are really, really cost efficient, really low cost airlines, focused on their jobs. Now they have an added tailwind of crude. So in my opinion, crude is going to stay lower for longer. How much? I don't know. Will it double from here? Even if it doubles from here, I think it's lower only. I mean, I would have given an arm and a leg if 3 years back you had told me that crude is going to stay below $60 for next 3, 4, 5 years. So $30 or $60, it is great news for this sector. So and the passenger traffic growth, it's 30%, is growing at 25 to 30%. So the demand has always remained secular. For the last 10 years, we have grown at 15%, and now there's a bump up.
So will aviation be part of your long haul portfolio? Just buy it and forget it for 3 years? It's more like a cyclical trade. You're renting aviation stocks or you're investing in aviation stocks?
So the business is cyclical. I don't deny that. But within a cyclical, there can be a company that can create wealth over a longer term period. And the cycle itself can last over a 3, 4, 5 year period. So we have witnessed in 2002-3 to 2008 how a commodity cycle lasted. I mean, of course, that was driven by China. But so a cycle can last longer than you and I know how long it will last. So at this point of time, we have bought it with a 3 year point of view.
So the way you always invest is that you don't look at the real beneficiary. You always look at the first derivative, or you always look at the second derivative. Assuming that so much of government spending is happening and it already has started, who will benefit because of the multiplier effect?
Difficult to say that's what the quest is on constantly. But as you rightly mentioned, sometimes the shovel sellers are the ones that benefit. And those are the better businesses, where your business is kind of protected from the vagaries of the cycles. Then that is what is more attractive than trying to just play a cycle. So within aviation also, it is not like we like the entire sector, because they have not been the great allocator of capital, or they have done some really bad mergers and acquisitions. So you have to go with a guy where there is the least chances of making a mistake.
TCS numbers were very ordinary. Infosys numbers were blowout. What is the messaging for large cap IT? One good number, one bad number.
See, IT sectors, we have become stalwarts. We have reached a stage where it's not easy to grow 15-20%. So growing at between 10 and 15% itself is a challenge. So can we expect dramatic returns from IT? At this point of time, it looks challenging. Plus, there are these effects of the disruptions that is happening in the world, with robotics, with automation coming in. And these guys employing like more than 500,000 kind of employee base, there is a risk to that. So having said that, I feel comfortable from a next couple of years point of view. They'll grow in double digits, but growing beyond that is not an issue. So the valuations also have corrected to this reality. So
the P multiples are in the teens now, early teens actually.
So there is no balance sheet issue with these companies. Only thing is the growth issue. So if you can find a company in this that is really ignored, like Infosys was maybe 4-6 quarters back, and where the growth can have a slight bump up, then the valuation can re-rate.
But is this a hard market for you because the pond in which you fish is the small cap pond, is the mid cap pond, and that's where valuations are not on your side. So what do you do in this kind of a market?
Tough. Wait for the company. I mean, overall, it's great to say that market has entered a value zone, but you still have to work and find that one stock, because after all, we are a concentrated portfolio and we are not going to buy the entire market. Across our clients, we don't own more than 25 stocks.
That's it, a very concentrated portfolio.
Very concentrated, and in a particular portfolio will not be more than 10-12 stocks. Okay. So we have to, each incremental bet has to be properly vetted. So yeah, it's a challenge, but that's why it's encouraging that markets are falling, and probably it will be easier now to get a good stock.
So right now the market is like a Flipkart sale, very well advertised, and if you buy right now, you'll get stocks at a discount.
Yes, the discounts have started in this year.
Okay. So what could give you disproportionate returns? If somebody is planning to buy right now, you're buying when pessimism has started. You're buying when the margin of safety is on your side.
Correct.
So which sector, stock, theme or idea is capable of giving a disproportionate return in next 3 to 5 years?
So our inclination is towards the consumption story. As I said, we do not expect a capex-led revival in this economy. It will be an urban consumption-led revival. Some of the catalysts that are lined up are: one, hopefully monsoon will be good; second, 7th pay commission; third, OROP; fourth, general economic revival due to the government spending. So having said that, then you have to look for businesses that are catering to that kind of urban consumption demand, whether it is branded apparels, whether it is aviation, whether it is tourism or hotels, whatever it is. Within that segment is where you will find the business momentum being strong for the next 3 to 5 years.
So the core of your consumption basket or consumption stocks or businesses you own, one is branded apparel, second is aviation.
Yeah, I mean, we own...
You don't own staples?
No, we do own one particular stock which I cannot name, but yeah, we like liquor industry as well.
So liquor, you pretty much like the market leaders.
Yeah.
So whatever themes we've discussed, whether it is aviation or branded retail or liquor, you like the market leaders.
See, if the gap between the leader and the number 2 is large, it's not like you will never look at the number 2 player as well. So there could be opportunity in the number 2 and number 3 player. That's what, if I take you back 4-5 years back, we had bet on number 2 in the battery industry, and that worked out beautifully for us. So maybe the opportunity is better in the number 2 player than the number 1 player.
In last 1 year, if I look at the market positioning, hope has become despair. When we will be interacting on the same forum hypothetically after 1 year, what will change? What kind of market do you think we could be staring at?
I certainly think it will be way more positive than what it is today. And I think this is the time when one should not lose hope or despair, and one should be looking at it as an opportunity that has a godsend opportunity, and the fruits of government action, good monsoon, and various other factors will play out. If not, I'm not confining myself to 12 months. Over the next 2 to 3 years, this is going to play out.
I was looking for that answer, that this is a bull market correction. It's time to get ready and prepare yourself for better days ahead.
Yes, I think so.
Ravi, really appreciate your time. Glad you could join us.
Thanks a lot.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. So that's the messaging from one of India's smartest investors, that get ready, differentiate between risk and volatility. What we are experiencing and what we are reporting so far is volatility. There is no risk whatsoever to Indian markets if you're a genuine long-term investor.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.